Hi, everybody. Welcome back to the People's Finance channel, where we aim to boost your financial education. I'm Jeremy Sanchez, and tonight's topic is recession and your portfolio. More specifically, we want to focus on the distribution planning of your assets there. So when we get to retirement, oftentimes we find a lot of people have done a good job accumulating wealth. They put a lot of education into accumulating wealth, but they really haven't studied or tried to plan for the distribution. So just trying to grow a big nest egg, which is great. But we also have to start educating ourselves on proper distribution planning. And while we don't know when the markets are going to go into recessions or be go into bull markets or bear markets, the markets are cyclical. So we have to plan for the fact that we are going to be in a recession or a bear market in retirement. Um, so it really matters what type of economy you're in when you go into retirement. We can take an example right here where an individual who retired in 94 with $1 million in their portfolio, they were going to need 80,000 a year um, to support their lifestyle. And at the end of 2008, their portfolio actually was up to 2.2 million. So that's even after all the distribution. So this was a great economic cycle to retire on. Now, if you take those same parameters and just move it over to a different time frame, right here, starting in 2000, $1 million portfolio, just like the last individual, $80,000 per year in distributions, they're out of money in 2011. Now, you might be saying, well, no, that's just that time frame. That's not going to happen to me. Anybody who retired in this time frame didn't think it was going to happen to them. And I'm not saying plan for doom and gloom, but I'm just saying your assets that you currently have need to be able to support um, your portfolio through bad times. And oftentimes we see that the portfolio, the fund makeup or fund profile doesn't do that. If someone's doing it themselves, or they're working with an advisor who's not that sophisticated in this area here. So we'll get into the fund options here, but in a second here. But few housekeeping, like the video, subscribe, share it, set the notifications, and come on back. We're going to go through a lot of comprehensive planning and topics. But coming back to distribution planning, what happens if you retire and the market crashes, right? Well, lots of people think they're diversified because they're using a Roth IRA. They've got their 401k, they've got their brokerage, they've got these three types of accounts, but that's really all they've got. They've got three different types of accounts of the same asset type. If you think about it, if the markets all go up, if the markets go up, all the funds go up too. If the markets go down, all the funds go down. The funds values go down. So they're really the same asset class. They're just in different accounts with different tax treatments. So you really haven't diversified your risk really. You've just diversified your tax treatment. That's it, your taxable distributions and all that. So you really need to make sure you've got the right underlying funds in there to support your portfolio during a market down cycle. And the risk with that, until recently, it's been very challenging to find funds that are defensive, that have good upside and very little downside exposure. Those just really haven't been around, or at least I have not been aware of them. They haven't really been around where you can really protect yourself to the downside and get some good upside on it. So when people are looking for that balance, oftentimes they'll look to real estate. So once you've got a good, talk to your financial advisor, whoever you're working with, your financial professional, to make sure the fund allocation, especially as you're getting close to retirement, is appropriate and can support it if that's how you want to manage your risk. Now, clients who want to manage the downside risk exposure, but still have good upside, they look to other asset types outside of the market, or inside of something else. And one common area is real estate. And if we look at that a little closer, why they get into real estate is because rental income, as long as there's still tenants in there, during market downturns, they're still receiving rent, right? So you're still collecting passive income even in a down market. So that's a really good asset class to have, because the more you can collect from an asset, a stream, an unaffected asset means you can leave these other assets alone when the markets are down. So pensions are great because it's the same concept. It doesn't matter what the market's doing, you're always going to get that steady, consistent pension income, right? There's really nothing that can interrupt or change the value of that pension there. Annuities are the same, very similar. Once you annuitize, you'll get a steady stream of income, and then some permanent life insurance, and there's a lot more options just depending on your financial appetite there. So it's really important to understand how you're diversifying your portfolio, because you've got portfolio diversification, which you need to do, which we were just talking about, making sure the underlying funds within these accounts are appropriate. There's tax diversification, which we've done here. You know, the Roth is tax-free distributions, the 401ks are taxable distributions. So you want to diversify your tax liability. And then third, you know, you can call it market diversification, where we try and reduce the market volatility that's going to hit your portfolio. So, and that really requires taking an extra step or a deeper dive into the fund election in the funds here to protect yourselves in downside and on the downside, or to introduce other asset types to do that part for us. So make sure you speak to your own financial professional on this, get their opinion. But yes, please like, subscribe, share. Thank you for your time tonight, and I look forward to seeing you guys on the next one.